This is All Things Financial, the nightly market recap. My name is Andrew Hirschhorn. Well, we saw it yesterday, Wednesday, June 14th, a pause in rate hikes by the Fed, the first pause in 15 months. The decision coming a day after the Labor Department reported that the Consumer Price Index, which is a key measure of inflation, rose 4% in May from the previous year, and that's the smallest increase in more than 2 years. Now, while it's down from a peak of 9.1% hit last summer, it remains about twice the Fed's target of 2% rate. Now, remember that the Fed had hinted yesterday there would be more increases in 2023 and really no rate cuts for the next 2 to 3 years. The next Fed meeting is on July 25th. But how did markets respond? Well, the Dow Jones Industrial Average barreling forward, finishing at 34,408, up 428 points. That's 1.26%. The NASDAQ up finishing at 13,782, up 156 points. And well, the S&P up 53 points, finishing off at 4,425.84. So the stock market indices, they're all responding positively. What's behind the Fed's decision to pause the interest rate hike, and also why the market's responding this positively? We had Dagan LaCourte on yesterday on our podcast. He's an investment advisor. He wondered if it might be buy the rumor, but sell the news. Well, certainly people were also buying the news of a rate hike pause. By the way, note that digital assets did not perform as well today. The price of Bitcoin tumbled down to about 25,400, down about 100 points or so, or 0.5%. That after the announcement that there was going to be more rate hikes along the way by the Fed yesterday. Now, we take a look at this inverted yield curve. What's an inverted yield curve? Well, normally you earn a lot more money going out longer, let's say on a treasury bond or bill, than if you went out a short term, right? They pay you more, they reward you for the long-term commitment. But, well, an inverted yield curve is the opposite. So the 3-year debt obligation by the U.S. Treasury paying 4.23%, not bad. But if you wanted to go out 30 years, they'd only pay you 3.85%. Now, a lot of economists say that the indication of a pending or an imminent recession or an ongoing recession is in fact the inverted yield curve. So that's an indicator that perhaps things may not be as rosy as the stock market indices indicated. One other thing, the first-time home buyers loan rate steady at about 7.24%, but that's up from 6.5% in April. So let's see what happens with that. And to keep things in perspective, as we do our financial survey, West Texas Intermediate crude closing at 68.95. So again, all the major indices up, at least the market's betting temporarily on, well, a bit of a spike in the economy, and the Fed holding back on being so hawkish by raising rates. It remains to be seen what happens. And we're going to be talking with investment expert Stephen Gould tomorrow. We'll have that out for you early afternoon from All Things Financial. He's a former trader and a former teacher, analyst, professor of sorts for the incoming trainees, the traders, and the account executives at Morgan Stanley, Deutsche Bank, as well as Goldman Sachs. So he has some definitive insights as to what's behind the Fed's pause in raising the interest rates, and also why the indices and the stock markets responded so positively. And so for All Things Financial, my name is Andrew Hirschhorn. Have a nice evening.